Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Shawn Cruz. He's a manager of trader services over at TD Ameritrade. With our midday update, we're going to take a look at all of the data that came out this morning, better than expected, and of course, some mention of the U.S.-China trade deal. Shawn, it's great to have you with me as always. And you mentioned risk on as the phase one trade deal has went through. A little bit late on the details, but went through nonetheless.
And really, we got that over the weekend. Going into Friday, it was still up for grabs if there was really going to be something done. The sentiment seemed to be shifting that there was something that was going to get signed over the weekend, and we did get that. So starting out the week, if you really just look at any risk asset, it looks like money is just finding a way to flow into that. And it's showing up in a lot of different spots. We've talked about the VIX quite often, Jill, and the VIX is now down around that 12 handle, which looks like it's generally as low as it gets. Sometimes it dips a little below that, but 12 usually seems like a good support level for VIX, just looking back over the past year.
Let's take a look at our first chart here of the day, and we can see that cyclicals are certainly leading over defensives this afternoon.
That's just once again that risk on. Now that we've got U.S.-China trade deal, they're hoping this gives us momentum when moving into the future, and it can actually maybe kickstart some of these economies that have been sidelined a little bit, trying to see what plays out with the U.S.-China trade discussions. But it's certainly going to boost demand for energy, financials can benefit, and then you're also seeing consumer discretionaries benefit as well, and semiconductors, always one that you should expect to see rising when you do get positive sentiment or even a positive headline out of the U.S.-China trade discussions, much less a phase one deal that looks like it's going to go into place.
And it's also going to move around fixed income as well. So if we take a look at our second chart here, we're taking a look at a spread in corporate bond yields.
So when you look at the 10-year bond, if you want to see just general levels of risk and what investors are doing, you can look and say at the BAA, which is sort of not the most quality investment grade. So it's when you want to go a little bit more into the risky side of things, you can go into BAA corporate bonds. And if you look at what's going on with these yields over here on the far right, it's really getting pushed lower and lower. And all that means is that money is flowing into bonds. So as bond prices rise, because more money is going in, bidding up those prices, that's what forces yields lower. And this can be taken as a signal that investors are moving into some of the riskier areas now that they have a good feeling that maybe this is going to be beneficial to a lot of those companies as we start to see maybe some global growth come back online.
All right, in the following chart here too, you're taking a look at some more high yield assets.
It's once again, it's more the same. The other one, we're looking at the 10-year, and you want to make sure you kind of take a look at both sides of that. So we looked at the 10-year moving higher and yields moving lower, but if you just look at what yields are doing in general, they've really gone off a cliff ever since it looked like we were going to get a little bit more of a positive outcome to phase one, and there's just been more money flying into these high yield bonds. This is another way that we can track bonds. It's the BAML high yield master index that they use, but definitely more money going into these risk assets. So we've seen equities move to all-time highs. We're seeing high yield bonds also get money flowing in, and we're seeing the VIX backing off. Pretty much lets you know that investors are going into risk assets wherever they can find them.
All right, and moving along to housing, that came in really strong this morning.
That was, and I think if you look at what you've been seeing over 10-year yields, they've actually been moving lower and lower, and mortgage rates really track the 10-year yield very closely. So I think it makes sense, as you've seen the yield pretty much on a decline, mortgage rates on the decline all year, that is something that's going to buoy housing numbers a little bit. It'll be interesting to see how this plays out for the home builders, because there's actually a pretty big backlog building up where we saw starts signed, permits signed, but we didn't actually get ground broken, which to me indicates that there could be a little bit of a boon for some of these home builders coming up. We just need to make sure that we can continue some of this positive momentum on the housing market.
Yeah, we've been doing some of the technical work with that on our desk upstairs, and they're certainly looking for some breakouts there. JOLTS, higher than expected jobs openings here.
It just points to more tightness in labor markets, and you have to ask yourself what's going on here. It looks like there's actually a little bit of a skill mismatch. So there were a lot of openings out there, which makes you think that maybe there's going to be more tightness in that labor market, and there could be more hires coming. But the fact that the openings are also remaining high, there's more openings than there are people unemployed, which is usually taken as an indication there's a little bit of a skills mismatch, and that's not something you can solve by just going out there and increasing wages. If you can't find the person to fill that role, it doesn't matter how much you pay them, they're just not suitable to fill that role. And I think that'll be something interesting to see moving forward.
I think so too, especially skill sets are changing. Finally, industrial production, that was a really good number as well.
It was a great number. I think if you looked across the board, you saw a lot of positive results in there. A lot of economists were expecting that to come out a little bit more positive than usual because we've got the GM strike over with, and that brought a lot more of that production online. But even if you take out the automotive industry, it was still a pretty solid showing across the board. One thing to look at here, and I think if this is taken as a good measure of business sentiment, business investment sentiment, that may not carry over into January if you're looking for maybe some of the progress on the trade front to show up in these industrial production numbers, because we've had the Boeing production halt, and that's going to take a lot of production offline. I think it'll be interesting to see just what the actual impact is in some of these numbers we see coming out here in the start of 2020.
All right, Shawn, great stuff as always. Thanks for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.